Hey guys, welcome to another webinar. And today's webinar is going to be slightly the same as every time we always have it. But I hope you guys enjoyed the book that I released last week. If you haven't received the book yet, make sure you check the last video that I posted on Telegram and you'll be able to download the book from there. The book is to assist you with your trading. Basically, it comes with some technical information, technical basics that you need in order for you to be successful in this game. Now, keep in mind, this is for educational use purpose only. I simply post these as my personal ideas and my personal outlook into the market. So you should always do your own primary research before you actually follow anything that I say. That being said, if you're new to the channel, welcome, and it's lovely to have you with us. So our strategies that we mainly look into is we're looking into three strategies, which is COT report. We'll call it COT, commitment of traders. And we're looking to seasonality. Then we're looking to something called probability. Now, I've done some assessment before I started this video because you can see, quite frankly, I have a lot of tabs open. And that's because I've conducted my research and I'm trying to keep this webinar as concise as possible. That being said, you might be wondering what is COT, what is seasonality, and what is probability. Now, COT is called Commitments of Traders Report, and it's basically information that's released to us by the government based on Freedom of Information Act and to avoid market manipulation. Now, the people that are in this, that release this reports is mainly big industries, big guys in the industries, companies that, trade massive volumes in the market because they have a tendency to move the market when they trade. So they have to release that information to the public so that, the public does not get roped in or, the market doesn't get manipulated and there isn't any trail for that, right? So that's why we tend to look into this information because it gives us access to the insiders and see what the big guys in the market are doing. Seasonality is just basically in the name, it's just a season. The market has 4 seasons, Q1, Q2, Q3, Q4. And in order to make successful passive income, in this game, and you want to be able to make this money over time, first you need to understand what season you're in. Secondly, you need to have a way to automate the system so it can work for you. Now, I do have a way to automate my system, but I do not share my automation. Right here on this channel, I do have some robots that do trade for me because I just tend to assess the market based on these information I'm about to show you now. And then I program the market, the EA to take those trades for me based on the information that I have assessed, right? And that's how you make passive income in the game. Now, for the people that are members in this website right here, this website in the background, they do have access to some of the EAs that I've used. And those EAs, for those that downloaded it, I've heard positive response from them, primarily when it comes to the take profit aspect and when it comes to the SL aspect, So that being said, seasonality is just a season. So you want to know what the market is doing. In certain seasons, the market might be moving sideways, in certain season might be moving up, certain season might be moving down. You want to know what season you're in. If you combine that season information or that seasonal information with the COT report, you have a clearer picture of what's most likely going to happen. If it's the season for it to move up and people are buying, the big boys are buying, you know that most likely the trade is going to go up. And finally, we have something called probability. It's kind of like a casino way of looking at the market because the market, let's not lie to ourselves, it's just a massive casino, right? You're going there, you're placing a bet. But if you look at the market as a casino solely, then you're gambling. You have to look at it from an investment perspective. Hence why we have the COT report and we have the seasonality. It allows us to align ourselves with an investment mindset rather than just looking at the probability, which is now just gambling. But utilizing all three together will give you a clear-cut insight into the market. And this will allow you to assess the market in a more, let's say, professional format. And it saves you a lot of time for you going into the, technicals and drawing lines and all of that. I don't like that, quite frankly. It's just long and it's tedious and I just can't be bothered to do it. So, me being the person I am, I had to find an easier way to assess the market without spending my entire life on the market. So without further ado, let's begin. So I have actually opened some of the COT report, but for those that have not seen the COT report, this is what it looks like. So you can see different categories, like 3 categories: non-commercials, commercials, and non-reportable. Commercials are the big guys, non-commercials are some banks, institutional traders, and all of that stuff. But we just focus here. I don't want to really explain about these 2 categories right here. I just focus right here. I just give you guys the meat. There's no point of me going around the bones for you. Just give you guys the meat straight up so you can actually utilize that in your own favor. So that being said, what I look at is the commercials. I might need to turn my mic up a little bit just in case you might not be able to hear me. I'll take a sip as well. Oh damn. So basically, what's happening is you look at the commercials, right? And what you want to look at if they're going long or if they're going short. Now, long simply means going up, means buying. Short means market is going down, means selling, right? So what we tend to do is we look at where they align. And as of the 29th of 08, keep in mind the COT report is not instant. It lags by a week. There's a week lag, but if you have this information anyway, a week lag, it doesn't really matter because combining with the seasonality mitigates that time lag that you have. And this assists you to see the market quite streamlined. So what we tend to do is we look at what they've done previously, and there's always collect this information, in real time because some people submit their position in different times. So, being in a week lag is perfect. I think there was a point that COT was actually a month lag, but they've reduced it to a week, which means they've done great work. So kudos to the United States government on that one. So moving on, we look at if they're going long or short, and all we look at is the changes. That's all we look at, right? There's stuff like open interest and all of that. That's just about liquidity and how liquid that position is going to be in that direction. But what we tend to do is we look at just these commercials if they're going long and short, because this is like a short-term information, short/medium-term information, and that's how we utilize it. So what we do is we look at commercials, we look at if they're going long or short, and we look at it on the changes aspect, just the changes. We don't look at this figure right here. We look at just the changes, which is here. So what we can see, they've added 20,000 new positions, 20,044 to be precise, in the short side, which means they're trying to sell, trying to go down, whilst some people had it 486 to the long side, trying to buy. Now you can see that 20,000 positions compared to 486, it's a massive gap. I will stick with these guys. Normally, I tend to like them when it looks something like this on the left, just all of them add in and they're taken away from their short. But this is more than enough. I mean, it works perfectly fine for me. So what I'll do is I'll do commercials and I'll look at them going short. So what I will do right here is this. I'll say COT report. I'll put gold. I'll put short. That's all I need to do, just to remind me what position they're going, what direction they're going. So short, right? That's it. Next thing I need to do is look at gold on the seasonality side. This is what the seasonality looks like. And sometimes you have them in different categories. So in this aspect, we have it in 5 years, 15 years, and 47 years, right? But what we tend to focus on is if all 3 are aligned. So that's the average of price movement in 5 years, 15 years, and 47 years. And my mind just went to something. Now there was a man I met like a few years ago that I introduced to this concept of trading, Mr. Ademola Ade Doja, and he's passed away. So I just want to say condolences to his family on this specific video. And he's a great man. I used to speak to him for quite a while on the phone, sometimes an hour plus and 2. And it's just sad to know that he's passed away. So may his soul rest in peace, and God bless his family. So back to this concept of seasonality. It's the average of price movement in 5 years, 15 years, and 47 years. Thank you, God. And basically what's happening is we tend to look at how the price, align in all 3 concepts. So in the past 47 years, as the price remains the same, in the past 15 years, it remains the same, past 5 years, as it remains the same. At the points that they look like they are all aligning and remaining the same, that's the highest possible point that you can make money. So basically, it means that point is more predictable over time. So over the past 47 years, it's been very predictable. right? So those points are like points like this, for example. Now, it doesn't mean because they align every time means the trade is going to happen always. If you're not looking at the COT report, for example, you will see that alignment. In certain years, it might not align, or if there's a war somewhere, or if there's something somewhere happening, market is fluid and it's based on emotion. People tend to react a lot. So you want to be very careful, and you want to only select the times that they're in alignment with your strategy. Excuse me. In this case, right now, this is where we are. So we are at the third, right? And let me just zoom in. So in order to zoom in, you just need to just grab an highlight. For those that have this, you know how to do that. So what you tend to do is we look at when they're all aligned, right? We don't want to take them when they're all like choppy like this. We don't want that. We want when they're all aligned and you have a big amount of move in front of you, not just a tiny bit of move. So you have a decent amount, you have like a week move ahead of you, or maybe a month, or maybe 2 months move, then that's great. So right now we are right here. We can see from this that the 5 years normally reaches peak up until 2021, it reaches peak at the second, which was yesterday, which is Saturday. Today's Sunday. So you can't trade that. And this is why probability is good, because probability keeps track of Saturdays and Sundays, and it allows you to align yourself perfectly. So today, Saturdays and Sundays, and today is Sunday, and you can see right here, normally gold tends to fall. So tomorrow, though, look at what we have. They align because the 5 years look like it's going down, 15 years look like it's going down, and the 47 years, even though it looks like it's staying stagnant, but it is going down little by little. So you have that alignment all the way from the 4th, which is tomorrow, and that should last you up until, let's say, around here, or let's say around here, to the 9th, right? So 4th to the 9th, right? So we're going to put gold 4th till 9th, short, right? So now we have gold looking short all the way for the entire week, right? Now we already have that. We move on to our next one, which is the probability. And I've already placed it in September already. So what you tend to do is you now look for the 4th. Now, what you want to look for, the way probability works, is it gives you the percentage. You can see it adds October, November, December as well in there. So it's calculated it for the entire year. This is a massive amount of computational power to calculate all of these stuff. When we render this information, because we're looking for information that is years, and in some cases, these this are decades old information. Some of them might be 4 decades old, 5 decades old, some of them might be 2 decades old information that we look into. So what we tend to do is we compute that information and we put it into something very easy for you to understand in regards to percentage. So you can always see at top and bottom plus buy and sell always add up to 100% on every single one of them. And what you want to do is, if you want to sell, for example, you want it to be in your favor. Now, from what we're seeing in probability is telling us we have the highest chance of going long or buying on a Monday. So which means this 4th should not be in play, because now it's risky for us to go in on the 4th. But look at it short after. The 5th look like a more entry point. You have 5th, you have 6th, but then 7th, it goes up, and then 8th, it comes back down. And it sounds like a Jamaican person a second ago. And the 11th all the way to the 13th goes all the way down. But we're more concerned about all the way to the 8th, right? Because 9th is a Saturday. 9th is a Saturday, so 9th will count. So what I would suggest is, because of this goes up, I normally like it when you have 3 days in your favor. 51% and above is fine for me, in your favor. But because we don't have that, this trade will be classified as a medium/high risk trade, because what we have now is we don't have the 4th. We're not going to go into the market on the 4th, as we've seen on the seasonality, because probability is telling us our best chances on the 5th. So we're going on the 5th, 6th, but on the 7th, you want to keep a close eye on the market, making sure the market doesn't take everything it's giving you back on the 5th and the 6th, right? And then we exit our trade on the 8th, possibly in the evening or sometime where we see there's going to be, because we're going down, where we see a support. So whenever we see a support on the 8th, we exit that trade and we take our profit. So that being said, probability, what we have is we have the 5th, all the way to the 8th. We go down, we go set, we go short, and risk is 7. All right, so on the 7th, we have that risk, which is because it's most likely going to go long on this day. So what we want to do is we just want to keep that in mind, and you classify this trade as medium / high risk. And voila, that's it. That's the analysis. So we know that I don't need to touch the market up until the 5th. So if I was to trade gold, for example, I'm not going to go in tomorrow. I'm not even going to look at the market tomorrow. I'll come back on the 5th and I'll look at the market and take my position on the 5th. Now, the way to take that position on a technical aspect, you might want to join the membership to see how we use certain technical tools. And we do have some technical tools on the website that you can download that will allow you and assist you to pinpoint where your entry should be, where your take profit should be, and where your SL should be. So that you make the most out of this trade and you don't end up losing a lot of money, or you don't end up losing anything at all and you make a lot of profit instead. So remember, this is it's a sum game, and you don't want to calculate it by how much you're making. You want to calculate it by percentages of growth. So let's say you have a $10,000 account. If you make $100, that's 1% growth. Banks do not give you 1% growth. If you make $200, that's 2% growth. I'm not going to front and say to you on that same day that you will make $5,000 off of this trade, because you don't make money like that in trading based on, taking one big risk at one time. That's how to blow your account. You want to take those wins little by little by little until they add up into something massive and significant. And it becomes to compound when you go over time. Because now, if you're not withdrawing your money, or if you're withdrawing some of it, I do recommend withdrawing some of it so you can actually, treat yourself. You want to understand that if you leave your money to keep growing, you can compound that into something big. Your 10,000 over time went on to 20, the 20 goes to 40, 80, 160, 320, and 640, and so on, 1.280 or something, whatever it is. Right? So that's how to trade it. So for this week, that's what I have for you. Gold, 5th up until the 8th of September, you go short, and the risk is, you have a risk on the 7th, and it's a medium to high risk trade. If you want to know where your take profit is, look into ATR. There's a video on ATR on the website. If you don't know how to get to the website is right here, business.dmempire.co.uk. And if you go to the pricing section, you can be able to purchase your membership and get access to this tool. Get the highest possible membership that you can, which is the one that is the professional tools, which gives you access to all of this. You don't need to get the access to the videos, but if you get the access to the tools, it's more than enough if you understood what I just, put out in this video. So if you understand it properly and you're grabbing it quickly, then you don't need the video membership. But if you don't understand it and you need more, then you might need the video membership, something to consider, and you can purchase that. Depending on what part of the world you're in, I normally shouldn't say this, the price is actually different depending on what part of the world you're in. So keep that in mind as you move forward. That being said, this is what I have for you today, guys. Gold. I do have other assets that we can look into. For example, we can look into the JPY. We can look into the CAD. We can look into the euro. We can look into the pounds, and we can look into NZD. But for this sake, I'm just keeping it short and simple. This is what I have for you guys. So thank you very much for attending this webinar, and I'll catch you in the next one. If you want to get the free ebook, make sure you follow the link in the description, or alternatively, look at the link in the previous description as well, in the previous video description. I'll put in this one anyway, not to worry. And you can join the Telegram group also. So trade safe, guys, and stay dangerous. Catch you in the next one.